Risk management's pretty well established in Asia, especially in the large economies like China or in places like where we are in Hong Kong here right now, where there's a good presence of international banks. The banks have been using credit scoring for approving loans and managing credit accounts for a good number of years now. So in contrast, the application of analytics to cybersecurity is in its absolute infancy, not just here in Asia, but around the globe. So for example, a few months ago, we had a group of 8 chief risk officers from banks around Asia, and we asked them that very question: do you feel that you're prepared for a cybersecurity attack? And 2/3 of them said that they felt underprepared. And so that gives us a little insight into your question of how prepared or how advanced the use of analytics is in the cybersecurity problem. I think the chief issue is that it's very difficult to understand what a cybersecurity attack actually looks like. It's easy to understand people who don't pay and who pay. There's a well-established way of looking at how many payments you've made and how many payments you haven't made. Cybersecurity attacks come in all sorts of forms and shapes and sizes, and so tackling that problem analytically is way more challenging than the problem of tackling credit risk is. The big issue is, how do you define the problem? We all read the headlines, but how analytically we go about tackling it in order to do something that's useful to the business is a very complex task. Cybercrime is a big issue. I mean, I read a story recently in the Financial Times where somebody from Lloyd's of London was saying that they thought they were getting to the point where it's actually uninsurable. That may be a little bit extreme, of course, but we know that the risks are large, and the risk comes in many shapes and sizes. To the bank. The bank is where the money is, if you like, and ultimately the banks are on the receiving end of much of the cybersecurity problem, even if they're not the direct recipient of the attack. So the data could be stolen from a retailer, but it gets monetized inside of a bank. The bank is on the receiving end because they are in the direct line of fire, in the sense of that's where the money is and that's where the stolen data tends to get monetized. But almost a larger problem here with cybersecurity isn't these sort of direct losses that come about through stealing the credit card numbers themselves. It's the reputational risk that's the real problem. A bank can be seen by their consumers to be less diligent, if you like, as a result of cybersecurity, not only through the losses that they incur, but the way that they deal with the reissue of cards. And if they're subject to a security breach themselves, the reputational damage will far outweigh any fraud losses. You know, we've only have to look at a recent example in the UK. It's not a bank, it's a telco company, Talk. They were breached just a few days ago, and their market values dropped by 1/3 as a result of the stock market reaction, which is trying to forecast the consumer reaction to dealing with that company. So put that in context for a bank, that could be extremely damaging. Not really. This whole area of applying analytics to cybercrime is in its infancy. And I think that the challenges that anybody faces in this regard is that it's difficult to define exactly what you're looking for. So every bank, every large company has some sort of security officer and security equipment, and they write rules and they generate alerts and so on. But those alerts can be large in number and difficult to separate the important from the less important, and therefore difficult to understand how to react to one alert and how to react to another alert. And so that's the challenge is the sheer volume of alerts that get generated. And so the role that analytics plays, where it's different than simply writing rules, is that it allows us to measure the severity of the anomaly. Right? This is about detecting things that are different for some reason. It might be that, a computer communicates across a network and that's just a normal thing for it to do at noon. But at midnight, it's a very abnormal thing for it to do. So using analytics to monitor that type of traffic allows us to put these alerts on a scale so that a bank or a retailer or anybody for that matter can say, this is an alert that we need to react to because it's further away from the norm than all of these plethora of other alerts that we get, which are actually just things that we can tend to ignore. The challenge is really one of rank ordering, the challenge of extracting what's important from all of the noise. Analytics is the answer to that problem. The first is to recognize that fraud and security and compliance and cybersecurity are all dimensions of the same problem. They're all interlinked. Data is stolen, fraud is committed. If I'm not monitoring correctly, I have a compliance problem, and I have to have my systems set up in a way that they are secure. So they're all facets of the same problem. The second thing to recognize is that this is a large and complicated problem. And so you can't solve it all in one go. So take small steps. Get people that operate in siloed organizations within banks talking to one another. Find a place where you can begin to tackle the problem and recognize that there are parallels between detecting fraud and detecting cybersecurity attacks, because they're all just about anomaly. They're all one form of anomaly detection or another. So there are parallels that are there. Use those parallels. And the third thing that I would say is that because they are all different dimensions of the same problem, is to think about having one person in charge. Increasingly, boards of directors are asking questions about, are we secure? What's our risk? And it makes more sense in a large organization to have one person responsible for all things risk related, not just credit risk here and security there and cybersecurity some other place, but to try and bring those three things together. And increasingly, particularly in the European banks, we're beginning to see that trend occur.